I want to welcome everybody. We're going to get started and appreciate all of you joining us from around the country. My name is John Miller. I'm a CPA, and we wanted to invite some of our financial advisory friends so that we can teach them how we can help you increase your assets under management. And some of the strategies that I'm going to give you today, I've seen work, and we feel like working with you as a community helps build our practice. Just to reassure you, we're not going to sell you anything today. The only thing we want to do is teach you, and by doing that, we feel like it benefits our business. And so we just like to pay it forward to this community so that you know that there are CPAs out there who are committed to helping you build your practice. I'm going to introduce a little bit about myself and my firm, and so that you know who we are. Just a little about me. I have a master's in taxation from one of the top 3 accounting schools in the country for the last 35 years. I've spent my time largely in public accounting. I did leave for a time to run a couple of technology firms as the CEO. I worked for 2 of the largest accounting firms in the world, PricewaterhouseCoopers and Arthur Andersen. Most of my time was at PricewaterhouseCoopers. Now they're largely known as PwC. I left there as a director, and then before Private Tax Solutions, I was a partner at a regional firm, GDM Private Financial Solutions, GDM standing for Goff Dance Miller. I've been a CPA since 1993, and I'm the managing member and founder of Private Tax Solutions. So a little bit about Private Tax Solutions. We're a firm that's largely focused on cloud accounting. You're going to see that concept grow over the next few years. I suspect we're kind of the innovators, leaders in that area, and really focused on bringing on businesses that want to have their books in the cloud so that they're always available to them. And then we focus on tax planning. Our clients largely look like service-based business owners, and then a group of individuals and families that represent emerging wealth, high net worth, high cash flow individuals and families, and then real estate investors. That's our niche. That's where we choose to spend our time. We don't do a lot of restaurants. We don't do a lot of construction firms. And we limit ourselves from businesses that do inventory. And that's really about focusing on our niche and doing the best job for our clients. So that tends to look like a lot of business owners and emerging wealth types of individuals. A little bit more, we are not a financial advisory or a financial planning firm, meaning none of us here have a securities license. We feel like that's kind of a conflict of interest to provide tax planning and tax services and accounting services, and we prefer to work with you guys as a team. So we expect that you are the highest quality professionals in your industry, and that allows us to focus our time and attention in the tax and accounting area. And we help you really build your referral business. In fact, we try to sell our clients on you. And we find that that's provides us the greatest opportunity to not only help you build your business, but it helps us build our business. It's a good model for us, and we find that we have much greater success when we're helping you build your business. We're located in Eastern Idaho, near the Tetons, Jackson Hole, Yellowstone. And then, as a side note, near our family. About 2 years ago, I lived in the Seattle area with my family, and my wife's family were having some health difficulties, and we felt like as a family, it made sense for us to relocate in the great outdoors in Eastern Idaho and live closer to our aging parents and allow our children to have a great outdoor experience. Just some pictures of my family, and I mentioned largely that we moved to Idaho for family. You'll see a picture of my wife. I have 3 boys at home, and I have 2 grandchildren. I'm a young grandpa, but we love the outdoors, as I mentioned, and what I'm really striving to do is build a lifestyle practice for our employees that allows us to offer great service to our clients, help you guys as financial advisors build your practices, and then build a practice that allows us to serve these individuals and businesses nationally. So we have clients from as far away as New Jersey and Texas, and we even have a client in Korea. So we're really not limited by geography these days with the availability of the internet and portals and cloud-based accounting solutions that are out there today. So the big question for today is, how can we help you build your business? And we know a lot of financial advisors, and a frustration that I've had with financial advisors is some of them seem to be focused on the short term. And what we're striving to do is help them build a long-term, sustaining, recurring business. By recurring, we're trying to help them buy into the idea of building an asset management business that they then can obtain an asset management fee of, say, 1% per year. Sometimes there's a split with your broker dealer, but we're striving to help you put your goals in total alignment with your clients. And we sell your clients on that type of a business. There are a lot of people out there with the misconception that asset management fees go against their goals. And we actually show them that, no, it's actually in alignment with their goals, and that those financial advisors that try and sell you on front-end loaded funds and front-end loaded fees and so forth are probably just the kind that are going to churn your account every 3 to 5 years and ultimately try to get the same management fee over time. Whereas if they buy into the concept of asset management, you can move in and out of the best investments at any time as the client, and it meets your needs as a financial advisor in that you have stable recurring income and are able to grow your business off of the asset management side. As I said, we sell you. So the first step is for you to understand, by selling yourself, you're really creating a difficult position. Whereas if you will focus on referring others and become a referral resource, and that doesn't just mean referring people to tax planning. That means referring people to commercial real estate brokers, referring them to attorneys and others. You actually become a referral magnet. And so we encourage you to, and we're going to teach you why, to focus on business owners. We like service-based professionals. Service-based professionals tend to have high net income percentages. So as a percentage of revenue, you see higher income, higher disposable income that they can then use to redeploy into these investment programs that we recommend them to use. And so we're really encouraging you to use the network to sell you, use us to sell you, but you connect them to expert tax planning. And hopefully we can persuade you that we know what we're doing in that arena. So we end up, if we work together, we like to see the situation where you sell us as the tax planning professionals. You know, I've been at this game for about 25 years, a little longer actually, but that's a nice round number. We teach people how to free up funds from their tax dollars. Tax planning, we don't try and ever put our clients at risk. We use proven, time-tested, code-based tax planning. We're just strong at the tax planning side. Show them how to free up some of their existing cash flow, and then we redeploy it into some of the investment programs we're going to talk about in a minute. But what we found is, and I found this in my practice over these last years, if I focus on selling me, it's really difficult. Every time, and you can probably relate to this, every time I have had a referral, it's almost a completed new client in our business. So when a referral comes our direction, most of the time, if we choose, and we have standards, but if we choose, that we'll add them as a new client. And I suspect the same is true for you. So imagine the difference. Rather than you selling yourself, you're making relationships with business owners, letting them know that there's some expert tax planning out there that can help free up cash flow. You arrange a complimentary initial tax planning meeting with me. We don't charge for the initial tax planning meeting. We do request that the client give us some information like prior year tax returns. And then we have this initial tax planning meeting together to see if we can free up funds. Now, when we do decide to engage in a full tax plan, we'll give them the strategies that we think will reduce their tax obligations, thus increasing their cash flow. And then we refer them back to you. And I'm going to give you an example of an actual real client here in a minute. But we're not talking about taking any of their disposable income. We're merely asking them to utilize their existing cash flow for some of these investments and some of the tax plans. Okay, so what does this look like for you? What's the math? Well, first of all, what we've generally seen with higher net income type service-based professionals, these would be dentists, doctors, or healthcare services. We've also seen IT professionals, consultants, real estate professionals, but generally we've seen that we can save them anywhere from 60 to 500,000 right off the bat with two primary strategies. One is what we call a defined benefit retirement plan. We like the cash balance plan, and we couple that with a profit sharing plan in their business. We help them overcome all the stigma because we basically show how the IRS is helping them to increase their assets that they're putting aside for retirement. There's also a strategy called a closely held insurance company. This enables clients to self-insure for certain Lloyd's types of risks, not the usual workers' compensation and that sort, but unusual risks. And then there are some real tax reduction strategies centered around these two things. So imagine this: if you could find 100 service-based professionals that are dropping in, we're not talking about simple IRA contributions of $12,500 a year for somebody who's under 50, or $15,500 a year if they're over 50. We're talking about somebody who can literally take a deduction for a couple of $100,000 a year in this defined benefit retirement plan, take the deduction. That money physically goes into their retirement plan, which you as the financial advisor manages. I sell them on the idea, and then I turn around and I say, okay, Mary or Joe, we work with regularly, and we believe that they would be a good professional for you to deal with on the investment side. We've dealt with them before. We have confidence in them, and they'll manage the mutual funds and the investments that you put inside of this retirement plan. Same kind of a concept happens with a closely held insurance company. It's just a lot more money. So rather than trying to chase down little simple IRA contributions of $12,500 or $15,500 a year, you're literally putting a dentist or a doctor or somebody in a retirement plan that they're dropping $200,000 a year into. So, at $200,000, you're earning an asset management fee of 1%. That's $2,000 per client. So again, that math, if you have 100 clients putting in a couple of $100,000 a year into their investment program, you're getting a raise equivalently of $200,000 a year. It starts to get serious real quickly as you work with these business owners. And again, you're not selling them on the retirement plan. That's probably the worst step you could take. You're selling them on the idea of, could we free up some dollars by creating a tax plan, by doing some modeling, some financial modeling, and seeing if there's a way we can reduce your taxes legally so that we can fund some of these programs. In the process, we sell them on the idea of using life insurance, a permanent policy like a universal or a whole life policy. We have a strategy where it allows them, and you're likely aware of this, of funding tax-free retirement, of creating tax-free retirement dollars, or in the short term, even using that to finance their equipment in their business or other business needs, and then earning that money right back in the inside value of their life insurance. I don't believe any self-employed business owner ought to be without a disability policy. If they insure their life, they ought to insure their income. And we teach them that there is a way to derive some tax benefits from their disability insurance premiums. Now, most people hear that if you deduct the premium, you cannot take the proceeds from a claim on a disability policy tax-free. And there actually is a way using the benefit of time. If they have the value of time, which most of them do, we can deduct those premiums. And then if there ever is a year where they need to start drawing on disability benefits, there's a way that we can structure that so that they can still draw down the benefits tax-free. And then again, a long-term care policy. We feel like that's important for most of these service-based professionals. They have the cash flow to do it. I'm going to show how this all ties together in a moment. But imagine going into every company, putting in place at a minimum a defined benefit retirement plan, and getting maybe $150,000 to $250,000 a year of assets under management, selling them on a life insurance policy, a disability policy, and a long-term care policy, and you didn't do the selling. You literally put them with a professional that persuades them to the need of this, and that professional, our staff and myself, we refer them right back to you to take advantage of those things and actually implement their plan. So, here's a little fun thing. The tax system that we're under has continued to gain in massive complexity, and that requires guys like me to spend a lot of time in the Internal Revenue Code and looking at the ways the laws have changed, and finding ways to help our clients save money. Unfortunately, what we've seen at the federal level is that taxes have been, are, and I think will continue to increase. The Bush era tax cuts are gone. These days, the new income tax bracket is 39.6%. When you add things like Medicare and Social Security taxes and state income taxes, you are typically seeing that most business owners are in a tax rate that exceeds 50%. And we'll see an example of something here in a moment. We've also added higher capital gains and qualified dividends taxes. Those have gone from 15% to now they're increased to 20%. And then we've seen deductions, and what I mean by this is itemized deductions being phased out. Of course, we're all aware of the Affordable Care or Obamacare tax impacts, and that again has trimmed into the cash flow of these business owners. And so, their taxes have gone up dramatically. And what we need is good tax planning to enable them to implement their long-term needs. So what do? Well, obviously we're not like these big companies who are moving abroad and lowering their tax breaks. We can't just move to Canada or throw our arms up in the air. I do think tax planning is probably the best plan for these guys to get on a financial path that allows them to improve their cash flow, keep more of their money. So I'm going to start here with, kind of how we start with our clients in our initial tax planning meeting. This is a real life scenario, somebody who is living in Hawaii and the situation that they were under. I can't use names, but I'll just give you the situation here. So the way we start is we want to first determine how much they need as a couple or a family to maintain a lifestyle that meets their needs and desires. And in this case, it was approximately $15,000 a month. We multiply that by 20 to give us a quick calculation on what their W-2s need to look like. And in this case, if we took $15,000 a month, multiplied that by 20, they're going to need W-2s of about $300,000. In this case, however, they earned quite a bit more. So you'll see that both of the spouses, their W-2s, of course, they owned their own businesses, so they had control over their W-2s. But they earned $883,456 on the W-2s. They earned an additional $31,000 in interest and dividends. And then they had Schedule C business income of $255,000 for total income subject to high tax rates of $1,169,519. Well, what that means is if we take away what they need, which is the $300,000 would fund their monthly needs and likely fund their tax bill. If we could somehow move some of that money to a tax-effective investment vehicle, that would mean that right now they have a surplus of income of $869,519 to basically move into something that they could escape or avoid taxation from. Now, we may not get it all, but at least that's what we have to plan with. That's the excess dollars that they don't need each year. And if you took the effective tax rate that they're under, adding state and federal and some of the other taxes they're subject to, in this case, they were subject to an effective tax rate of almost 50%, 49.5%. So that means that they're paying needlessly $430,000 in taxes a year. $430,000 that if they could somehow move into a retirement plan or some tax-advantaged investments, the IRS could almost be seen as helping them meet their long-term financial goals. And this would obviously benefit you as the financial advisor because you could help them redeploy these dollars. So what we do is this is kind of what the whole tax plan strategy that we designed, we came up with. We found a way to basically move about $300,000 into a cash balance defined benefit plan. We like cash balance plans. We work with an actuary who's outstanding at these and setting them up. He sets them up with financial advisors all over the country. And I've just rounded the numbers, but moving $300,000 into this cash balance plan, would save this guy and his wife $148,500 roughly a year. Well, you could look at this a little different in that the $300,000 of contributions was funded actually by the IRS in tax savings. So in effect, he's only giving up about half of that in cash flow. And he really didn't need it in the first place. He and his wife only needed the $300,000 a year. If we did this closely held or wholly owned insurance company, we could pick up another $250,000. So automatically, we're looking at increasing a financial advisor's assets under management to the tune of over $500,000 a year. Now, they may not do all of this plan in the first year, but let's suppose they only do the defined benefit plan. First of all, you just got a raise for $3,000 that year. Next year, you get another raise for $3,000. So now you've got at least, I hope, $600,000 of assets under management, and we haven't even added the earnings that you earned off the first $300,000 of contributions. We're going to reposition. We often suggest our clients maybe reposition their assets into something more like a growth stock because they're subject to some investment taxes that happen now under the new tax regime for investment income like dividends and interest. So we might suggest that they, move some of their portfolio into something that's not going to be subject to the additional tax. In this case, they had this couple had an adult daughter going to college, and well, actually a couple of kids, I think. And, we could find a way legitimately. We don't create anything phony, but legitimately the kids were working for mom and dad. striving to earn a little money for their college education, but mom and dad were just contributing to that college education. Well, why not create an employment situation where mom and dad employ the kids? And you might say, well, what could they do that they could possibly earn $42,000 a year? Well, we do need to do a compensation analysis to justify that number. But what if they were doing something as a social media analyst, where they were doing the advertising and the social media work for the family online? These are kids that know how to use Facebook and LinkedIn and Twitter. That tends to actually be a pretty high paid position. So we might be able to use some of their cash flow to fund the kids and their needs for obtaining an education. By the way, there's some other strategies we can use, but in this case, it looked like about $42,000. And as I mentioned, we believe that most of these, service-based business owners ought to have long-term care, disability, and life insurance. Now, we can't deduct life insurance, but we can sure deduct long-term care and disability insurance. We have a cool little strategy where we will actually take after-tax dollars spent for healthcare, create what's called a medical expense reimbursement plan. You can only do this with some types of business entities, but this is an opportunity for them to, again, move tax dollars, after-tax dollars in this case, that are already being spent, to pre-tax dollars and get a benefit. We've done some fun stuff with something called conservation easements. It's basically a charitable contribution strategy, and depending on the state that the client is living in, like the state of Colorado, there are even some additional benefits state-wise that you can avail yourself of. So in this case, we were able to use $861,000 of their cash flow, but it didn't require $861,000 because $426,000 of that was achieved through tax savings. And we were basically able to help them fund some long-term investment strategies, pay for kids' college educations, and then protect themselves from some of the risks that exist to a service-based business owner. So in this case, it actually benefited them quite a bit. I'll just mention real quickly, some people have never heard of this closely held insurance company. It's actually in the Internal Revenue Code. It's Section 831B. And in the case I just gave you, we showed how they could move $250,000. We can't just pick the amount. We have to use actuaries and we have to do a study and all kinds of things. But in effect, they set up their own closely held insurance company. And if the actuaries and the people that do that side of the work tell us that it is available, they can actually deduct up to $1.2 million from their primary business. And that goes into a closely held insurance company. Those dollars are typically required to be held in high quality blue chip stocks and bonds and mutual funds and the like, depending upon the insurance jurisdiction, which state it is in, or sometimes they'll put these in the Caribbean. But the dollars never leave the United States. They're held in an investment account that you guys manage as financial advisors. So think of this as kind of a souped up, investment program, like the defined benefit contribution or the defined benefit retirement plan that we talked about earlier. The cool thing is that a closely held insurance company isn't taxed on its assets. It's taxed only on the investment income. So the interest and dividends are taxed, but the receipt of premiums aren't subject to tax. So it's one of the coolest strategies out there for tax planning that we have, in addition to the defined benefit retirement plan. So in this case, what did we achieve? Well, we reduced our tax obligations by $426,000, more than $2.1 million over the next 5 years. That should be, for the most part, assets under management that you guys will be able to deploy. We used $287,000 of the tax savings just for retirement and improved investment positioning. In one case, in the daughter, we were able to moved almost $21,000 towards a retirement plan. And then, of course, the thing I feel good about is we protected them against the risks of disability, loss of life, or long-term care. So we are protecting them in a better situation than they had before. And so they can sleep a little better at night. And then, we moved a small amount of after-tax dollars spent on out-of-pocket health care costs and moved it to pre-tax deductible expenditures. This is all the legal stuff I have to show. I'm almost done here. Obviously, tax and accounting advice is only going to be rendered once we enter into an agreement with the client. We look at their unique situation. It's not going to work for everybody, the things that we discuss. Some people won't want to use some of the strategies. I don't understand that, particularly if it would benefit them so much. But you'd be surprised. Most clients, once they're exposed to this from a CPA, are very interested in moving forward with protecting themselves with life insurance, disability, long-term care, and starting a retirement plan. But the nice thing is you don't have to sell it. And by selling it, I mean persuade them to the idea. I sell them on the idea. And then for you, it's a complete laydown. It's so easy to then pick up that referral, and knowing that they're ready to start a retirement plan, set them up with that account, and now manage those assets for them. So I'm just going to simply say, look, give me a call to see if this will work for some of your clients. Let's start working together. Let's target some service-based business owners and some high cash flow income families. And I'll do the initial tax planning meeting at no cost. I merely want the opportunity to get up to bat with these folks, show them what we can do. And if in our initial tax planning meeting, we think we can do something, then we'll move forward and create the actual tax plan. We'll do the financial and tax modeling, and we'll work with you guys to then set them up to start the retirement plan, get the life insurance or disability insurance. We'll sell your prospects on you and the strategies. We don't provide any of these tax products or any of these financial products. We don't sell them the actual investments. That's your job. That's what you do as a holder of a securities license. You manage those assets for them. You sell the idea of tax planning to them on us, though. And so that's where we work very efficiently together. Once you refer them to us, it becomes very easy for us and for you to work together to help them get into what they need to do going forward. I'm going to put my contact information up. We also have a toll-free number. It's 1-844-PRIVTAX, PrivTax, I guess. But we have a couple of office numbers. The most common is 425 area code 644-4663. You're also welcome to email me or my staff at any time. I'll give you my personal email at the office is John, Jon, there's no H, John@privatetaxsolutions.com. So want to thank everybody on the call. Give me a call, and I think that's about the time that we have scheduled. We told everyone we'd probably do about a half hour to 40 minutes, and I'm going to choose to stop at this point. I'd love to talk with each of our financial advisors and financial planners on the phone. So, again, I don't charge for my time with you guys unless you decide to become a client, of course. I more want to figure out ways that we can work together, go to the market, and find good businesses that both you and I would like to work with long term. So give us a call. Again, our office number is 425-644-4663. And my email is johnjon@privatetaxsolutions.com. And again, I just want to thank everybody for joining us today. I look forward to working with you, and have a great afternoon. Goodbye.